Hello, everybody. Welcome to another great Drive Profits module, module number 5 with MBA Broker Consultants here on another Wealthy Winning Wednesday. Woohoo! Who is excited? Who's excited to be here today? Okay, welcome, everybody. We're going to go ahead and jump right into our material today. We have an awesome presentation all about your financials, crunching them, and finding out the bottom line. So who is with me and who's ready to get started today? Go ahead and type into the chat where you're joining us from. Hello and welcome, brokers. Just let us know what city, state, or zip code you're joining us from and how we can help you drive profits to the max. Who's ready to accelerate your real estate brokerage and push the needle, win the game, and finish strong? Welcome, brokers. Thank you so much for taking time out of your busy workday. I know it's very challenging because you spend so much time working in your business, managing your agents, recruiting agents, keeping deals from falling apart, or shall we say transactions together, and pushing the needle. So it does take a lot of discipline to be able to book out some time on your calendar and make that time available to work on your business. So thank you for being here with us today. This is definitely worthwhile for you to make that time available. Go ahead and start your engines. Rev up and let's get ready to go. We're going to speed through this masterclass series. This is our third masterclass series. Our first was Scale Up Your Brokerage, which was Blueprints to Build Your Empire Profitably. Our next one was Be the Boss and Dominate Your Market, all about innovation. And now we're on Drive Profits to the Max. So if you didn't get a chance to take a look at the other masterclass series, be sure to do that. We're going to learn today how to maximize profits. Start strong with your custom dashboard. Now, today's topic is really the heart and soul of this whole series because we're going to break down the financial statements. We'll show you how to read them, what to look for, and how to improve that bottom line, which is your profits. A little bit about us at MBA Broker Consultants. We have an online training program with MBA Business Academy, a membership program. We offer consultations, business plans, workshops, retreats, and we also travel to various real estate agent conferences and give keynote presentations. So we'd love to help you not just play the game, but change it, right? Everybody else is playing the game. That's what your competitors are doing. We're going to put on our business owner hat, our innovation hat, drive profits through the roof, and change the game of real estate brokerage firms. Today is our Today is our 5th module out of 8. So 5 is financial statement review. We've already gone over the SWOT analysis, operational management, business planning for growth, accounting and banking. So last module, we touched briefly on accounting and we talked about the financial statements. Today, we're really going to zoom in for a close look at those financials. A little bit about me. I will be using some of the core concepts from the MBA program. I also have a BA degree in real estate brokerage owner, just like you, for many years. And after so many years, I decided it was time for me to step outside of my box, I guess you could call it, my brokerage, and impact everybody else in our industry, especially independent brokerage owners who are struggling, and to elevate the standards of professionalism by teaching the business skills that I've learned along the way that maybe others have not had the opportunity to learn yet. So that's what we're doing today. We are using tips, techniques, and examples from the Association of Accredited Small Business Consultants. I'm an accredited business consultant with them. Okay, welcome everybody. I see we have more people joining us. If you could please just type into the chat, let us know where you're joining us from so we can say hello to everybody and welcome you. Today's topic is all about the financial statement review. So we're going to cover four main areas: the financial statement review, revenue and expense review, asset and liability review, and then a ratio analysis. And the financial statement review is going to include your income statement, balance sheet, cash flow statement, and the owner's equity statement. So who's ready? Let's get started. Okay, we do have a worksheet for you today, so let me go ahead and make that available. Okay, I just shared it. It's called Drive Profits Module 5 Worksheet. So if you could download it, please let me know in the chat if you're able to download the worksheet. When you put the worksheet together with all 8 of the worksheets from the various modules, you'll have a complete workbook for Drive Profits to the Max. So what's inside the worksheet? You probably are asking if you have never seen one before. Well, we're going to have an outline of today's module so you can take notes, and then we'll have a self-analysis for you to go back and analyze your business. And then lastly, we'll have the books and resources, our 2 favorite books that we recommend on today's topic. And today's topic is financial statement review. Woohoo! Money, profits, the fun stuff. Who's ready to get started? Show me a sign. Changes ahead. That's pretty much sums up our industry, doesn't it? A lot of changes ahead, a lot of things that we see happening, and how do we stay relevant and continue earning a profit? And more importantly, how do we build a solid foundation that will last our company for many years into the future? Hey, Ted, thanks for joining us. Ted from San Diego County. Glad to have you with us today. All right, now let's start off with a poll here. And our first poll is, okay, you did see this last week, on the last module, but that's okay. Same question. How often do you review your financials? So the answers are, and I have them published now: A, I print and read my financials weekly; B, I study them monthly; or C, only when it's tax time. So hopefully it's not C. Okay, so far we have some C's, but that's okay. I'm going to give you the skills and teach you how to read them on a regular basis. Now, weekly might be a little too much, but definitely you want to review them monthly and then probably quarterly as well, so you can compare them year over year. Okay, we'll give you one more second to go ahead and answer. We have a few more people we're waiting for answers. All righty, we're going to go ahead and publish. Everybody so far has said they review their financials at tax time. So today we're going to show you how to read them so you don't have to wait till tax time and have your accountant to be able to review them. The first thing we're going to go over is a financial statement review. Now, this measures the financial health of your company, and what is more important than its financial health, right? This might seem a little complex or intimidating at first, but as you practice this review process, you're going to become more comfortable with it and understand it more. Now remember, these are all just numbers, right? We're just number crunching, but remember that all of these numbers represent some type of business activity, and the numbers either have a positive or a negative influence. So let's take a look at that. And when we review our financials, it actually tells a story. A business story emerges from these numbers that we crunch. So the first thing is our financial statements. We'd like to review at least 3 years, 5 years maximum, but minimum of 3 years if you've been in business for 3 years. The reason is because you want to be able to have something to compare. You want to look at trends, not just dollar amount trends, but percentages, and we'll get to that in just a minute. So the way to do it is to start with the accounting period, beginning with the earliest month, quarter, or year, and I'm going to show you an example by year, and then you go to the right with each future period to the right of that. Okay, so this is an example of an income statement. And I'm going to turn my little whiteboard here and my red marker. So in this income statement, we see that we have sales right here. And then we subtract from that our cost of sales, which is the variable expenses. In other words, how much it cost us to be able to make those sales. And a good example is the split that you pay to your agents. Every time they make a sale, you receive revenue, but you pay a percentage of that back to them at the closing. So that would be your cost of sales. And if you subtract this, the revenue minus the cost of sales, you end up with this number, your gross margin. And then you have more expenses to subtract, and those are your fixed costs. I call them your overhead operating expenses. And those are things that are called fixed, not because they're the same amount every month, but because you have those costs every single month, regardless of if you close a transaction, if you have income or not, you're going to have those overhead expenses. So that's your salary, your lease or your rent, or your mortgage for your building, your equipment, utilities, things like that, marketing, training, tech tools, your insurance, of course, professional fees, your dues and subscriptions to the Realtor Association, the MLS. So you have all those expenses every month regardless. Okay, so that once you subtract that leads to your net profit right here at the bottom. Okay, and sometimes you'll see it referred to, if you watch the Shark Tank, EBITDA. And that's a fancy term. I explained that last module. We won't go over that again. But basically, that's your take home before you pay your taxes. And you want this number to be as high as possible. So when we go through today, we're going to be calling this your top line. I'm not very good at writing with this little marker. Okay, so your revenue coming in, your gross revenue, that's your top line. And then here, this is your bottom line. Bottom line is your net profit, right? That's what you put in your pocket. Oh, after you pay the IRS. Okay, so we call that our bottom line today when we're going to be going through this. Okay, any questions on your income statement? Please let me know now, because now what we're going to do is we're going to take this income statement and we're going to compare it year over year to see how we did. We're actually not going to take this one. I have a different example for you, but please let me know if there's any questions so we can try to iron those out before we get to the next step. So here's the next step. This is a sample real estate brokerage firm. This is not a real company. It's completely fictitious. These are made up numbers just so we can understand the concepts. And so what we did is we took our year. We just had an income statement, and here's that income statement for last year. we'll say it was 4 years ago, right? And then each year we add on another year, right? Another income statement. So this is 1 year ago, right? Year 2, year 3. So we really want to compare these and understand how we're doing. If we're doing better or worse, you can see that there's a trend going across. And the trend is revenue is increasing. That's right here. And gross profit is increasing right here. Yay, hooray, we did a great job. We can also look right here to see the operating expenses. Oh, those are increasing as well. And our net income before tax is increasing. Wow, that's a good thing. And most importantly, our net income after tax is increasing. And that's the bottom line, right? So you can see year number 1, it was 51,000. Year number 2, 79. Year number 3, it actually went down 50,000. And then year number 4, 158,000. So we need to know why it went down between here and here. We see the revenue went up. We see the gross profit went up. So what happened that made our net income go down? And that's why we compare year over year and why we look at it. So let's take a look at what we did here. We have our total revenue, just like you saw in the previous slide. And then you subtract your cost of sales, which would be, for example, how much you pay your real estate agents every time there's a transactional closing. And then that leads to your gross profit. And your cost of sales, again, those are variable expenses. Then you have your operating expenses, right? Those are known as your fixed expenses. And these are all the things included in there. There's probably a lot more. We just made this very simplistic so we can explain the concept. So you add up all these operating expenses, right? 44,000 for the year. And then you take your gross income, you subtract your operating expenses, and that leads to your net income before taxes. Then you pay your tax, and that's your net income, 51,000, and that's what you can put in your pocket. Well, not literally. Hopefully you're paying yourself some wages right here as a brokerage owner, and that means your net income is a profit that accrues with the company. We saw a little bit of that last module, okay, with the owner's equity. So that's all good. That's a good thing. So we basically did the same thing year number 1, right? We went through all of these income and then subtracted all the expenses to get to the bottom line. Year number 2, we did the same thing. Year number 3, year number 4. And now it really paid off with 158,000 net profit on year number 4, but we still don't know why we went down here. All right, so let's get to the next step and talk about what and why. So our income statement review, we just saw an example of 4 years of the income statement compared side by side in the columns. And we're going to do 4 things to that. So the first thing we're going to do is adjust for abnormal expenses. In other words, we're going to normalize it. Then we'll prepare common size statements. That's where we turn it into percentages. And then we'll do an inquiry where we ask ourselves questions. And lastly, convert from cash to accrual basis of accounting if we haven't already. So those 4 things we'll do is the first is to adjust for abnormal expenses. I call that normalizing. So what we'll do is we'll go through that with a fine-tooth comb and we'll pull out anything that might be a personal item that should not have been included in there. Something that's not tax deductible or Somehow it got thrown in there. We need to pull those back out. Also, perhaps there were related party transactions that were not at fair market value. An example of that might be perhaps you sold a house for your mom, and your normal commission that you charge to clients, the end user clients, say it's 5% for your mom. You didn't charge her anything when you listed the house, but you charged you paid the other buyer, so you had to collect something. So maybe it was 2.5%. So there's a reason it's not at fair market value. Had that been a fair market value transaction, what would the actual income have been? So you're going to go back and add that in. Also, extraordinary salaries of owners. In other words, it's way too high or way too low compared to the average in your industry. So in the shot just before this on the screen, we saw the salary was $35,000 a year, which is, pretty low to be able to survive, at least here in California. So maybe there's a reason it's low. Maybe you don't want to take a big salary because you want to reinvest in the business. So that needs to be adjusted to be the correct, what the average would be. Or maybe perhaps you have a family member. Maybe it's a son or a daughter, and you decide that you want to pay them more, or a spouse, husband or wife. Maybe you want to pay them more than the average for some personal reason. So, and if so, that needs to be adjusted back to what the average would be. And any non-business expenses, you want to go ahead and pull those out. And that's what we call normalizing the income statement. And by normalizing, now you can understand where you're at and why. The next thing we'll do is to prepare a common size statement. And I have an example of that coming up. But that's where you take dollars and you convert that to percentages, right? If you have, it always starts with 100% at your top line of your revenue. So that's always 100%. And then that allows you to compare the year, right? The percentages within each year, and then compare the year to other years. And most importantly, this allows you to compare your company with your competitors on an industry-wide averages and trends. Okay, so let's take a look at that right now. An example. This is the same dollar amounts that we just used a minute ago. Turn on the whiteboard here for you. And what we did was, instead of dollar amounts, we converted everything to percentages. So here's year number 1. Our total revenue, I said the top line's always 100%, and then everything else gets compared with that. So your cost of sales is subtracted, and then your gross profit, right here, 52.5%. And then your advertising gets subtracted, your dues and subscriptions, insurance, office expense, wages, payroll taxes, and your total operating expenses. Again, these are your fixed costs. So just kind of glancing down here, we see that wages really stands out because it's the biggest dollar amount, 17.5%. And the total operating expenses really aren't too bad. The total is only 22%. Now, if we take this gross profit, 52%, now we subtract the operating expenses, we get to this number, net income before taxes, it's 30.46%. Is that a good number? Is that a bad number? Well, we don't know yet because we don't have any context. Then we pay our income taxes, 4.57%. And then we come up with this number, net income after taxes. It's almost 26%. Again, we don't really have any context. It seems like a good number, but we don't know unless we compare it. So let's do that. Let's compare year number 2. In year number 2, we had our cost of sales was 52%. So our cost of sales actually went up, comparatively speaking, and our gross profit naturally went down. Okay, so now we have all of these same expenses here, and our wages are actually a bit higher, and our net operating expenses are a little bit higher. So all of this means that with our cost of sales being higher, which is our variable expenses, and our fixed expenses being higher, all of that means that the bottom line right here, net income after tax, is less than 20%. So comparatively speaking, our income percentage-wise went down, or our profit, I should say, went down. So why is that? That's going to be the next step, is where we examine why. Again, the same thing happened for year number 3. Our cost of sales went up again. Our gross profit, see, that's even lower, went down, which is bad. Our operating expenses went up, which again is bad. And so our net income before taxes is only 11%. And now our net income after tax is only 9.19%. So percentage-wise, compared to year number 1, that's really, bad. It just went way down. And even though the numbers seem like they were good because they were higher, comparatively speaking, it was not. Now, again, we would do the same thing for year number 4. By the way, when you hire our company as consultants, we do all of this for you. Okay, you don't have to do any of this. All you have to do is push a button in QuickBooks, send it over to us, or have your bookkeeper or accountant send us everything, and we'll common size everything for you. Okay. So again, year number 4. It seemed like we made a lot of money, right? It was $158,000, but the net income was only 19.8%. So actually, it was higher than the year before, but it's not as high as what we were doing year number 1. So these are important things to look at. And then also, we need to look and see what the industry is doing. Industry benchmarks is what we call that. And see what the trends are, what the percentages are. Is this good or bad compared to what my competitors are doing? And those are important things to know. Okay, so that's it for the common size, normalize. Any questions, be sure to let me know. I don't see anybody typing in the chat, so let me know in the chat. I'll be sure to answer your questions. Now that we went over the income statement and we said, there's some unusual things here. So what do we do about that? Well, now we need to have an inquiry. That's where we ask ourselves, or if you're working with a consultant, the consultant will sit down and go over with you any extraordinary items or unusual expenses or things that happen. Were there any operations that were discontinued? Are there any errors that should be adjusted for, or prior period adjustments? Maybe they were wrong. So, there were some numbers that were wrong, but you didn't find out until after the year is over and you closed out the year. So maybe you need to go back and do some adjustments to that period. And the last thing that a consultant would recommend that you do is to change from a cash basis of accounting to accrual basis. We talked about this in module number 4, so we'll review it very briefly, but cash basis means that you recognize the revenue when it's received, not when it's earned. And same thing with expenses, that you recognize them when paid, not when incurred. As compared to the accrual basis, where you recognize revenue when earned, not received, and you recognize expenses when incurred, not paid. So just to break it down, an example for you would be, say, for example, you have an REO account and you go out and do the work, and then you bill the asset management company. Okay, so according to the accrual basis of accounting, you've earned revenue because you've done the work. But according to the cash basis of accounting, you have not yet earned revenue because you haven't received the money for it. Okay, so accrual basis is more complex, but it is the standard used for accounting purposes. So just be aware of that. All right, we have another poll. Who's ready for another poll coming up? This poll is, do you have an accountant? Now, in the last module, we said, do you have a bookkeeper? So now we said, do you have an accountant? And the answers are A, yes, we outsource. B, yes, we have an internal employee who does our accounting. Or C, no, I do everything myself. Now you just saw how complex these businesses are. So hopefully, unless you have a background in accounting, hopefully you are outsourcing this or you have an internal employee. Now, for most of us indie brokers, we are going to be outsourcing. We don't have the staff and the infrastructure to have a full-time employee who does accounting. So most of the time we will be doing outsourcing. Okay, I have some answers coming in already. C, I do everything myself. Any other brokers voting? Let us know. You outsource, internal employee, or do everything yourself. Now, outsourcing, I think, is probably the best solution because you're not paying for a full-time staff. You're sending everything to your tax preparer, your accountant. Hopefully you found somebody who's really good that understands real estate brokerages and the unique business we have. Okay, go ahead and publish the poll there. Now, this is my secret sauce. I'm going to give you 7 ways to boost the bottom line and talk about why this is so effective. The first thing I want to point out is the traditional model. The traditional model of real estate brokerages is hire more agents. Hire. Just keep hiring like mad, which there's nothing wrong with that. In fact, it is important. That's probably the number one thing that we need to be devoted to as a brokerage owner is hiring agents, recruiting, right? We call that recruiting. We're always in recruiting mode. Recruiting is the lifeblood of our business. But what good does it do to hire more agents if you're hiring unproductive agents who aren't producing, or if you're not profitable with the agents you hire? And we talked about this in my Brokerage Empire session number 5, was all about profitability that your agents are bringing you. And if each agent is costing you $1,000 a year and you're just in hiring agents mode and you go out and hire 10 more agents, you just lost $10,000. So that did not boost your bottom line. So that's pretty silly to just hire more agents without knowing that they're profitable, the split that you have them on or whatever fee structure is profitable in your business model. Okay, so number 1 is the easy answer: hire more agents. We should be hiring more agents. But number 2, charge agents more to ensure that they are profitable, and that not that they are, but your company is profitable for each agent. And how can you squeeze more bites out of that same apple, right? Get more bites out of that same apple. What else can you charge them for? A desk fee, a technology fee, advertising fee, right? Instead of just a one-time fee, monthly fee. The third way is to increase agent productivity, and that is to work with each of your agents and have a system in place to teach them how to be more profitable. So the same number of agents, now remember, you're probably going to lose some agents, you're probably going to gain some, but even if your agent count stays the same, if each agent is more productive, wouldn't that boost your bottom line, right? Without having to worry about hiring 200 agents. If you just had 30 agents and each of them was 20% more productive, that could boost your bottom line by 20%, depending on how you work your commission split, of course. The next tip is add revenue. Now, this is an often overlooked area for real estate brokerages. because we're so focused on transactional sales. But what about adding product lines? Now, the product line that's simplest to add and that complements your transactional sales is property management. So think about property management. What else can you add? Okay, there's a whole lot. I won't go over all of them in this module, looking at my time, because we're going to get through this in an hour. But if you go back to my Empire session modules, I think it's probably 6. I'm just guessing, but there's a couple modules in there about your product mix and adding products to your bottom line. REO accounts is a simple and easy way to add another product line. And yes, there actually are REOs going on every day in the real estate industry. And if you don't know about them, it's because other brokerages are grabbing them. So that's a great revenue line to add. Now, the next one in adding revenue is to sell multiple services to your current clients. That means you have a client whom you just sold a house to, or you're going to sell a house to. How can you sell that person multiple services and again take more bites out of that apple? Maybe you have a mortgage company or a mortgage affiliate. Maybe you have a home warranty company or an affiliate. Perhaps you have a property management company. That person is an investor. You're going to manage the property for them, right? So think about how you can take those same clients you already have and sell them multiple things. Even if it's not your company, it could be an affiliate, and you could be earning a small piece of income from doing almost no work because you already have a captive, happy client. All right, the last section is cutting costs. This is what I call below the line, below the revenue line. And we don't often think about cutting costs, but that's a very important part of best business practices and of managing any company well, is to always be looking at the costs and how they can be reduced. And there's 2 areas, of course. We just looked at the income statement. So reducing your cost of sales, which is your variable expenses. And that's typically, for us brokerage owners, that's the compensation you pay to your agents. And reduce overhead expenses, which are your fixed expenses. And that's your office overhead and things like that. Unless it's your own salary, you might not want to reduce that because, that's part of your profitability. But again, how can you boost the bottom line at the very bottom? Well, start at the top, increase revenue, sales agents, cut costs. Okay, any questions? I just gave you 7 awesome tips. I hope you can start the wheels turning to implement in your business. All right, we've got some more financial statements to talk about. The next one is our balance sheet. And I don't have an example for you here right now, but the balance sheet is something that we went over in the last module number 4. What you want to do with the balance sheet is you want to do the exact same thing you did with your income statement. First, you want to normalize it or, remove anything that shouldn't be there, and then convert your dollars to percentages and then review the trend. So by turning it into what we call common size, which is where everything is in a percentage, now you can look at the trends and see what items are off that should be adjusted, or at least it should start you thinking about the question of why are these numbers off, or why doesn't this look right, or why is my trend this way when it should be this way, or how does it compare to others, my competitors in the industry. And then with your cash flow review, you're going to do the same thing. And again, from last module 4, your cash flow only reflects the cash received and expenses actually paid. It doesn't reflect non-cash items, depreciation, amortization, and of course accounts payable, accounts receivable, and things like that, but it might include some balance sheet items. So what is detailed in the cash flows? That's your operating activities, investing activities, and your financing activities. So those are the three categories or groups. Now let's talk about what that cash flow statement, or it's called statement of cash flows, right? That's a traditional name. Let's talk about what that allows us to see by common sizing it and looking at percentages, and then really taking a close look. We can see things like cash reserves, cash flow, borrowing, spending, commingling finances, and these could be financial pitfalls for your business that you could not even be aware that these could be danger signs until you actually start taking a closer look. So that's a great reason to start examining your financials. Next, let's look at the revenue and expense review. Any questions, comments, be sure to type in the chat. Let us know what you're thinking. We're here for you. We do have a poll. Our next poll is, what areas do you think you can improve? So let's get this poll going here. That's our last poll for today. What areas do you think you can improve? I'll give you just a moment to go ahead and answer A, revenue expenses, B, assets and liabilities, or C, all of the above. All right, great. We've got some answers coming in. C, all of the above. Revenue and expenses, we just went over. Assets and liabilities, we'll be going over next. Or I guess we're actually going over both of those sections now. So it's kind of hard to say until we've gone over them, but this is just to get you starting to think about what areas that you can rev up in your business to really boost that bottom line and make sure that you are going to be profitable. And not just a little bit of profits, but maximum profitability, paying yourself a salary, right? That's important. And then also having some profit banked for the company as owner's equity or stocks, right? So your revenue represents your actions, your company commitments, marketing efforts, ideas, people, history, and future of the company. The revenue is a very, very important measurement. It's an important number, not just as far as the bottom line, but what it represents in the overall picture of your business. Like we said in the beginning, your numbers, they paint a story when you start putting them together and analyzing them. So you want to review your revenue by total revenue. We saw that just a minute ago on the income statement. Also by gross profit, both dollars and percentages, pricing trends, marketing dollars attributable to each line of revenue. Now, just a minute ago when we looked at our income statement, we looked at revenue just kind of lumped together, but ideally we would want to have that broken out into different types of revenue. For example, transactional sales, property management, maybe referrals, REO accounts, any type of revenue that you have, you want it to try to identify it differently so you can actually zone in on that and determine which one is the most profitable and why. Okay, so this is just what I was saying. You want to analyze it by category. It could be by the product you sell. It could be the service line, a department, a division. Perhaps you have one big corporation, and under the corporation you have several other companies or corporations. So you want to make sure that you look at each of them individually by category. And then you can really tell what's really going on behind the scenes. That allows you to ask those tough questions about the revenue, about why are these numbers going down on the bottom line instead of going up? Even if it's a percentage instead of a dollar amount, or especially when it's a percentage, then we know it's gone down instead of up percentage-wise. Increased cash flow is so important. Cash flow management is key, especially we know in this business, we don't get paid until the work is done, right? We get paid for production, for performance. So how do you keep your brokerage cash flow positive? Okay, well, we have a few suggestions for you. Some of them may not apply to your brokerage, but speed up collections. Now, in a typical transaction or property management, that doesn't apply. But if you think about REO accounts where you've often spent, $10,000 out of pocket or, per account, and you're sitting on that for 90 days, how can you speed up those collections? Request auto pay, fund transfer. Use vendor payment terms to your advantage. In other words, you pay early and get a discount on various accounts that you might have. Request milestone payments when you set up. Don't say, oh, pay me in 90 days. Maybe it's pay me a third in 30 days and another third in 60 days and the remaining 40% in 90 days. Trim your expenses, obtain a line of credit. Consider non-traditional financing. Now, ACCRUAL is a really wonderful organization that helps small business owners, and they're here in the San Diego area. There might be some other non-traditional lenders in your area who help small businesses, but just make sure that you're not getting in debt and have a high overhead expense that you can't cover later. The next thing you want to do is increase your revenue and gross profit. And again, there are a whole list of different ideas here. And I sort of went over a few of those, gave you some really great ideas. But again, you can see add or eliminate a product or service line, differentiate your product or service from the competition, consider changing suppliers to get things at a lower cost for you. And the first one, increase or decrease pricing to see the effect on total revenue and gross profit. And again, you can check that yourself and do some test runs on paper before you actually implement it. Now, one thing to remember, if you are raising your prices, you can expect you will lose some customers or clients. So you need to make sure that it's going to still be more profitable if you raise your prices. And we talked about a little bit about cutting those expenses, right? But remember, it's not just about expenses, about cutting them. You have to look at your expenses and say which ones are out of line and should never have happened or should not be part of the business. And all of your reductions of expenses, they should be logical, prudent business decisions. And if your company is not operating effectively or efficiently, the key word is efficiently, make sure that you take the appropriate corrective action to reduce the expenses and increase your operational efficiency. In other words, more bang for your buck, right? Now, expense reports. Dr. Richard Weinberger calls these possible deception in the making. And expense reports are when you have other people who are submitting expense reports and they get reimbursed for things. Remember that those types of things are prone to abuse, and you have to have an accountability system or process in place that you follow every time, and that you scrutinize things if they look out of line. Don't just rubber stamp approval, sign and approve everything, but make sure that you are looking at that. Now, especially if you have outsourced your bookkeeping and your accounting, it's great. I do encourage you to do that, but again, take a look at the bottom line yourself and make sure that everything is as you expect, and don't be afraid to question or make an inquiry if not. And that's where this report comes in. This is called the Revenue and Expense Narrative Variance Report. And what it does is Again, you can prepare it for your company. You can hire consultants like us to prepare it. And we go through your financial statements to better understand why certain accounts increased or decreased. And it makes your research of past activities more efficient to understand why things are varying. That's what a variance report is. In other words, it's deviating from the norm that you would expect or from the trend, or there's something unusual going on that you need to take a closer look at. All right, now let's dive into the asset and liability review. Are we swimming in numbers yet, right? So the review of assets and liabilities is your historical balance sheet. Again, we're going to do it the same way we did with the income statement. We're going to look at it by dollar and by percentage, and then we'll review it and find if there's any abnormal variances involved. So the types of assets, there are many different types of assets. These are in your notes. You can take a look at the different types of assets: cash, buildings that you own, furniture, equipment, inventory, vehicles, things like that. And there's different terms that you would need to be familiar with to look at that, such as cash equivalent, might be a CD in the bank, things like that, depreciation, fair market value, book value. These are all accounting terms. And the last thing is factoring. And that's what happens when a business sells its receivable to a third party at a discount. We don't see that very often in real estate. But say, for example, you have an accounts receivable where you've billed the REO account, the asset management company, for REO work. You're waiting to receive your payment for that. And instead of waiting to receive, $10,000 in 90 days, you sell that to a third party and they buy it for you and they pay you, say, $6,000, and you get your payment in 30 days. So that's an example of factoring, and probably not very applicable to many of your real estate transactions. But be sure to ask those hard questions about the assets. Sit down with your management team. Now, there are different types of liabilities. Again, you can refer to your notes for all of these. I won't go through them one by one, but liabilities are things that you owe. They're debts that you have, taxes payable, credit card payable, things like that. And then some more accounting terms are the unrecorded and contingent liabilities. So these are things that might not be on the books per se yet, but they are things that are coming down the road, like warranty work that needs to be performed, retirement plans that are not yet accrued, and things like that. And what you want to do is, again, sit down with your team, ask those tough questions about the liabilities, find out why the liabilities are what they are, how you can reduce them, thereby increasing your net, your equity. Okay, our last section is ratio analysis. And this is going to be in your notes. We won't spend a lot of time on it, but ratios are a good way to, again, look at percentages, compare your business year over year to your own business, and then compare your business to other brokerages in the industry. The most common types of ratios that we would use in a real estate brokerage are the current ratio, the acid test ratio, also known as a quick ratio, working capital, which is really not a ratio, it's a subtraction problem, debt to equity, profit margin, total asset turnover. Those are probably less important unless you have a lot of debt and you own real estate. Then you'll probably want to start looking at the debt to income ratio. But there are many other types of ratios. We won't talk about them because they're generally not applicable to real estate brokerages because we don't have inventory. We're not manufacturing widgets and things like that. We don't do a lot of accounts receivable, accounts payable. So the current ratio is current assets divided by current liabilities. And it's a short-term liquidity ratio. It measures your company's ability to meet its current obligations. In other words, is there enough cash in the bank to pay all of our current vendors that we owe money to. Hopefully there is. Hopefully that's a positive number, right? If it's less than 1, then you know you're in the red, you're in the hole. The acid test ratio or quick ratio is the same thing, except for instead of just cash, you also include cash equivalents and accounts receivable that you could quickly collect, or things that you could readily liquidate to become cash, even though they're not cash. Then working capital, again, this is a subtraction problem. You take all of your current assets, subtract your current liabilities, and it will tell you how much money that you have to continue growing and funding your company's operations, purchasing inventory, marketing, or other things you need to do to grow your company. And the debt to equity ratio, again, this is total liabilities divided by total equity. And this is an indicator of the relationship between the company owners and the creditors. And it shows the amount of protection that owners provide creditors. And again, if you don't have many debtors that you owe money to, you don't own any real estate, this is probably not very applicable to your brokerage. Profit margin ratio is net income to net sales, and this reflects a measure of how efficient the company is at producing sales and turning those sales into net profit. So this could be a really good ratio to look at your company. Net income to net sales and total asset turnover measures a company's ability to use its assets to generate sales. If you don't have a lot of assets, like many small business brokerages don't, this is probably not as applicable, but to those who are growing, acquiring assets and acquiring agents and, really developing their company, this could be important. Again, all of these things are covered in our company consultation. We do have private consultations available. They're one-to-one with our consultants and your brokerage owners. We will go through line by line, give you our recommendations, and then we'll prepare a plan of action that shows you what the next steps to take to put that into action and make sure that your company becomes more profitable and stays profitable and continues growing. So, what is your action plan today? Well, first of all, watch the signs, right? We've seen a lot of signs in today's presentation. Watch the signs and see what's happening. That's what the financial review is. It's all signs that show you what's going on, what's happening in your business. You want to print those financials out. You want to go to the worksheet that I shared with you. Go through that, consult your CPA or accountant, and then, of course, you can always talk to our company about a consultation. Here's an example of the activity worksheet that you should already have and be reviewing. And then there is a company analysis there to help you accelerate and push that needle. Not just moving the needle, pushing it forward. So today's recap, we had a financial statement review, revenue and expense review, asset and liability review, and then a ratio analysis. And you learned how to do all of that for your company. The financial review is all about paying attention to the road signs, knowing where you're going by looking at where the signs are. Any questions? If there are any questions, be sure to just type into the chat, let me know, or you can feel free to reach out. I'm here for you. I'm available. Now, I always end with a couple of great books that I recommend. So today is no different. The two great books, and by the way, these are in your worksheet. The two great books for today. Now, I had a hard time choosing because there were about 5 really awesome books I wanted to include, but I settled on these two. Thomas R. Idelson wrote a book called A Visual Guide to Financial Statements. Well, he has another book that's much more complex, but this is a great starter book. It has illustrations and teaches a person who's not financially savvy. It really teaches them the basics of why financial statements are important, how to review them, and how to increase your company's bottom line using the financial statements as a tool. The second one is HBR, which stands for Harvard Business Review. It's a resource that is commonly used in grad programs, MBA schools, business colleges, things like that. And their book is Finance Basic for Managers. Speak the language, decide with data, and manage profitability. And the reason I love this book is because it gives you all the basics, but it's not complicated or difficult to understand. It really walks you through step by step. So those are my 2 picks for the day today. Hope you enjoy both of those. And remember, we have our master class for brokerage owners, Build Your Brokerage Empire. And I'm just going to go ahead and share that offer with you today as we close out master class. There we go. All right, I'm sharing the master class for brokerage owners. Just click on the little blue button that says Discover. It'll take you to our half price discount page with all 12 courses. It's really awesome. Now, some of you joining me today, I know that you already have the Brokerage Empire class, the 12 sessions. If you do, that is wonderful. What I need you to do now is go back and listen to them, right? It doesn't help to have them if you don't make the time to work on your business. So be sure to work on your business. Make the time. I suggest put aside 2 hours every week. That's not a lot. You might have to, make time out of your schedule by taking something else out, and that's okay too. Speaking of which, our next module is budgeting for capital Zoom. Who's excited about budgeting? More money, more profits. We're going to keep going here. So join us again next week for that module. Rev up your engine. Let's get ready to drive. Thank you, everybody, for joining me. Drive profits to the max. Accelerate your brokerage and push the needle. This has been a really wonderful day. I appreciate you taking time out of your busy schedule to work on your business, to join me in learning how to look at your financials, how to understand them, and most importantly, how to use them as a tool to increase your company's profitability. So thank you again. We'll talk to you later. Signing off for today, this is Regina, an MBA Broker Consultants. Bye, everybody.